All right, y'all. We're going to talk about Wyckoff. This is an introduction to Wyckoff. We're going to be viewing Wyckoff from a fundamental approach on this video, basically outlining how Wyckoff is to be observed. You know, what is Wyckoff really? And I can't take credit for Wyckoff because I'm not the inventor of Wyckoff. However, I've made Wyckoff tradable in my own way, which we will be outlining in future videos. But before we get started here, as you can probably see in the title, I clearly outline the requirements for this series, okay? Please take these requirements seriously, because if you start off in this series, you are going to have one heck of a time trying to get through this, okay? Because it's not going to make a whole lot of sense. We need to understand market structure and order flow. We need to understand supply and demand. We need to know what liquidity is. We need to absolutely know what ranges are prior to completing Wyckoff or understanding Wyckoff. So again, this might be a little bit boring, but it's all stuff that you need to know to really get to the level that I'm at in terms of Wyckoff. So Wyckoff's analysis suggested that the market can be effectively understood and predicted by carefully examining the principles between supply and demand, which are revealed through the study of price movements, trading volume, and time, which we're talking about a basic candlestick chart. Okay? So as a broker, Wyckoff had the opportunity to observe the actions of highly successful individuals and groups who controlled specific assets. When I say highly successful individuals and groups, I'm talking about market makers. So by utilizing vertical bar charts and point figure charts, he could interpret the future intentions of these influential players or traders. So the diagram below illustrates Wyckoff's conceptualization of how these larger traders prepared for and executed bull and bear markets. To capitalize on potential price markups or bull markets when substantial amounts of stocks were accumulated, it was advisable to enter long orders towards the end of the preparation phase. When I say the end of the preparation phase, I'm referring to anywhere within here. Okay? On the other hand, short positions were recommended to be initiated at the conclusion of the preparation for price markdown. Talking about on this final leg here, following confirmation. In summary, Wyckoff's methodology revolves around studying supply and demand dynamics through price action, volume, and time analysis. So by observing the actions of these major traders or players, he sought to anticipate these future market movements and identified opportunity to enter long or short positions. So as you can see, let me just try to fix this diagram here. As you can see, this is a basic idea of what Wyckoff is all about. It's not the typical Wyckoff diagram that you may have seen if you Googled what Wyckoff is, because there are different versions of Wyckoff, of course, and there's different schematics for both accumulation and distribution, for both reaccumulation and redistribution. But this is just the general idea, okay? So you have market structure in red here, and I try to outline that using a lower low, a lower high, and a lower low. So one of the biggest misconceptions with Wyckoff is that when you have an accumulation or a distribution, it's a absolute top or an absolute bottom. This is very, very false and inaccurate. This is not the way you should be viewing Wyckoff in any way, shape, or form. In fact, Wyckoff produces what we refer to as an order flow objective, meaning that if you see an accumulation model confirm itself, the order flow objective is going to be based on market structure itself. So in this case, we are drawing the accumulation and the distribution in a downwards trend, and a higher time frame downwards trend, as you can see again in red that we just overlapped with the black doodle before. So what that tells me is that order flow expectation, or rather expectational order flow, would be that a lower low, lower high, lower low situation would make the most sense. So even though on the previous lower low, right here, we see evidence of accumulation, the expectational order flow, or the objective of that accumulation, is simply to come up to mitigate supply for a distribution and to continue on with the overall downwards trend. This is the inner workings of what's going on here, okay? Because every lower low or lower high is a distribution or accumulation in one way, shape, or another. Now, whether or not it's a tradable schematic, I cannot answer that. Okay, this would be a distribution. This would be an accumulation, regardless of time frame. Is it tradable? Can't tell you. We don't know that. It isn't every single time. All right. So during oversold conditions, we would expect accumulation. Accumulation is very easy to identify because it usually presents itself in a rounded fashion. Distribution, likewise, it presents itself in a rounded fashion. Okay. A sideways trading environment that just so happens to eventually break down from the trading range. Or for accumulation, a trading range that just so happens to break up, right? With a rounded fashion. Okay. That's just a simple, very, very simple way of looking at it. So in accumulation, positions are oversold, meaning that price has been traveling in an aggressive downtrend, time frame dependent, of course, for an extended period of time. Ultimately, putting in a lower low and not being able to go much lower. Why? Well, because the markets are attracted to liquidity. There could also be inefficient price action that was created on this downwards trend that we need to redeliver efficient price action to in order to continue on with the overall downwards trend. We need to trap more traders into thinking the bottom is in to continue on our merry way south. That's how you need to think of this. Okay, so we have an accumulation phase followed by a slight markup in price, followed by an internal shift in structure, followed by a continuation of the overall higher time frame swing structure downwards trend. Okay, whereas the trading range in this case was a distribution schematic. So this is just the basic bones to what Wyckoff is. Okay, that's all we're showing here. It's just the basic bones. Now we're going to continue on with the theory. I'm not going to slam you guys with, hours upon hours upon hours of theory. I just want to clarify that before I go any further because I know how this stuff works. Listen, I've read it all. And I'm telling you, there's not much out there that gets straight down to it or explains it the way that I'm going to explain it. In fact, I don't think I found anything very similar to how I look at Wyckoff. But anyhow, we will continue on and we'll get to that. So Wyckoff's chart-based methodology is built upon three fundamental principles that significantly impact various aspects of the analysis. These principles guide the assessment of the current and potential future direction of the market and individual stocks or cryptocurrencies. The selection of suitable stocks for long or short trades, the identification of breakout points from trading ranges, and the projection of price targets in trends based on a stock's behavior within a trading range. And when I say trading range, I'm referring to a sideways range, the simple range that we should already know how to identify. Swing low, swing high, confirmation, a simple range. Because again, what are ranges? Well, every range either breaks up or breaks down eventually. So what does that tell us? It's either a distribution or an accumulation, or reaccumulation or a redistribution. Whether or not it's a tradable range, we don't know. So these principles serve as the foundation for analyzing every chart and making informed decisions about which stocks to trade. And I'm just going to tell you guys now, I wrote it from a stock perspective. So if I say stock, I'm also talking about crypto, same thing. So let's break down these three main laws. The law of supply and demand. So the law of supply and demand is at the core of Wyckoff's trading and investing approach. It dictates that price direction is determined by the balance between supply and demand, the amount of stock available for sale, and the interest from buyers. So when demand exceeds supply, prices rise. And when supply surpasses demand, what does price do? Well, it declines. So evaluating the balance between supply and demand is accomplished by comparing price and volume bars on a chart. Okay, you can look at volume as well with the standard volume tool. Although straightforward, to accurately assess supply and demand patterns and their implications, it does require a lot of significant practice. I wouldn't expect to go through this series and be a pro within a couple of hours. Not going to happen. Not going to happen. I'll tell you guys that. Don't even think that's going to happen because it's not. And if you do think that, you're going through one of those, what do they call it? A genius phase where you think you're a genius when in fact it's not actuality. So be very careful and put this to practice. Okay. Keep on with everything else that we've taught in the course so far. And don't just jump in and think that you're a Wyckoff guru because it doesn't work that way. This stuff takes a long time to grasp. And you're trading it in conjunction with everything else, of course, right? A little disclaimer. So the law of cause and effect. The law of cause and effect helps traders and investors set price objectives by estimating the potential extent of a trend that emerges from a trading range. Okay, expectational order flow or the order flow objective, same idea. Wyckoff refers to the cause as the accumulation or distribution phase within the trading range. The extent of the trend that follows is known as the effect. Same idea of what we were just looking at before, okay, up here. So we had the cause right here. This is the cause, the accumulation being the cause, the oversold conditions being the cause. We had that accumulative trading range. Price broke up from that trading range, indicating a shift in internal market structure, where the effect is this upwards trend, which was to create a lower high on higher time frame swing structure to break internal structure and continue on that overall bearish downward swing trend, which was the effect. So cause, effect, cause, effect, cause, effect. Okay? Just so we're on the same page. Point and figure charts are used to quantify the cause through a horizontal point count. This count is then used to project the expected distance of price movement corresponding to the point count. Essentially, this law assesses the force of accumulation or distribution within a trading range and its subsequent manifestation in a trend, whether upwards or down. Same idea of what we just talked about, right? Cause and effect. Law of effort versus result. The law of effort versus result serves as an early warning for potential trend changes. It involves analyzing divergences between volume and price, which can signal an impending shift in price direction or trend. For instance, when there are multiple high volume bars indicating significant effort, but with narrow price ranges and a failure to achieve new highs, okay, let's say volume is increasing, but you're not creating new highs. What does that tell you? Well, that tells you that price is likely to distribute, okay, especially after a substantial rally. Right. So what that tells us is that the prominent market participants might be offloading their shares in anticipation of a reversal where you have that shift in market structure. So high volume, high volume, high volume, volume spiking away, right? But you're not really getting any results here. That's barely a higher high. It's just a wick. This is barely a higher high. Again, it's just a wick. That's not really a great sign, right? So you can observe volume. And that's basically how Wyckoff was looking at this back in the day, right? Looking at Wyckoff from a volume perspective, or his method based on volume. So in a summary, Wyckoff's chart-based methodology relies on three fundamental laws to analyze markets and stocks. And these are the three laws that we just went over. So the Wyckoff method aims to enhance market timing for taking positions by foreseeing a potential move with a favorable risk-reward ratio, which is key. Okay, if it doesn't make sense from a risk-reward standpoint, you've got no business taking that trade, even if it is a Wyckoff model. Trading ranges are key areas where the previous trend, either upwards or downward, has come to a pause and a state of equilibrium exists between supply and demand. Okay, again, we're talking about ranges. Okay, we're talking about ranges here. Notably, major institutions or market makers and other professional players prepare for their upcoming bullish or bearish campaigns during these trading ranges as they accumulate or distribute their shares. So we're watching for the key signatures, right? Which side is it deviating more frequently in a range? If it's deviating both sides, then it may be harder to depict that picture. But if it's deviating one side, price is favoring deviations on one side, and you got all the volume confirmations, and typically what? It's typically in a distribution, especially if you're in an area that makes sense to dump from an overall higher time frame perspective, right? Based on structure, based on expectational order flow, etc. So within accumulation and distribution trading ranges, the composite man, the term used by Wyckoff to represent the large professional traders or trader, actively engages in buying and selling. The crucial distinction lies in the outcome. In accumulation, the shares purchased outnumbers those sold, whereas in distribution, it's the opposite. Shares sold exceed those that were bought. So the extent of an accumulation or distribution determines the cause that sets the stage for subsequent price move out of the trading range. So within this course, you will learn the following: the difference between these Wyckoff models. Okay, we'll learn the difference between Model 1s and Model 2s, reaccumulations and redistributions, the way we should be looking at those, how to identify accumulation and distribution trading ranges using schematics, my version of it, of course, the difference between tradable and non-tradable schematics, because there is such a thing in my opinion. Some are more risky than others. Rules of engagement in order to capitalize off these trading ranges. And one final thing is we'll be learning what's a reasonable expectation from a Wyckoff model. Okay. All right, guys, we'll continue on with the Wyckoff series, but again, please do not do so unless you have went over everything else that I've outlined at the beginning of this video.